market drop we've seen so far is just the beginning. Because here's the truth. The headlines are giving you one version of the story, but the real numbers tell another. And if you're basing your decisions on the wrong story, you could buy too soon, sell too late, and watch thousands of dollars disappear. Even in Calgary, not every market is moving the same way, which means you might think you're getting a deal, when in reality, you're walking straight into the next price drop. To understand what's really going on and where the market might be headed, let's start with the bigger picture, because what's happening in the economy right now is shaping the decisions buyers and sellers are making. In July, Canada lost 41,000 jobs, and nearly all of that came from full-time positions, down 51,000. That's a big shift from the month before when we gained 83,000 jobs. So while July doesn't erase all of the previous growth, the reality is this. Since January, employment has barely moved. The employment rate, which tells us how many people are actually working, dropped to 60.7%, and the unemployment rate held at 6.9%. And that's the highest it's been in 2025. Where it gets especially concerning is youth employment. Canadians aged 15 to 24 lost 34,000 jobs. That's a huge number. Their employment rate dropped to 53.6%, the lowest we've seen since '98, and their unemployment rate climbed to 14.6%, the worst since 2010. Certain sectors got hit hard too. Culture and recreation lost 29,000 jobs, and the construction industry, which is crucial to real estate, dropped 22,000. And we're seeing signs of deeper issues. 23.8% of unemployed Canadians are now long-term unemployed, meaning they've been looking for work for over 6 months. That's the highest level since, again, '98. Now, let's focus on Alberta. In July, Alberta lost 17,000 jobs, the most out of any other province. That's a 0.6% drop in total employment, and our unemployment rate spiked to 7.8%, up a full percentage point in just 1 month. That's the largest single month jump anywhere in Canada. For context, BC lost 16,000 jobs and their rate only rose to 5.9%. In Ontario, unemployment now sits at 7.9%, and in Toronto, it hit 9%. But those changes were more gradual. Alberta's shift was pretty quick and sharp. And while we're dealing with job losses, Carney failed to negotiate a tariff deal with the US by August 1st, so we've got 35% tariffs, and this applies only to goods not covered by the Canada-United States-Mexico Agreement on Free Trade, better known as CUSMA or USMCA. This is already rattling confidence in trade-heavy sectors, and according to StatsCan, workers in US-dependent industries are significantly less confident in their job prospects, with tariffs now one of the top 3 concerns. And the irony, it's Ontario and Quebec, the federal government's political strongholds, that are feeling the brunt of these trade uncertainties. Meanwhile, Alberta, for all the recent job losses, still has key advantages: affordability, growth, and natural resources. Sectors like manufacturing and services are still in contraction territory, and inflation remains sticky. Canada's GDP growth has slowed sharply in 2025, with high borrowing costs and a weaker global demand cooling business investment and consumer spending. The Bank of Canada held rates steady in July, leaving the overnight rate at 2.75%. They don't have to make a move now, so they didn't. You can check out my latest video here about why I think they held rates. This is a tough economic moment, but Alberta has weathered worse and we've come out stronger. So I'd still rather be navigating this economy from Alberta than anywhere else in the country. And this is where that risk I talked about at the start comes in, because if you just read the national headlines or even Calgary-wide stats, you could walk into the market thinking prices are dropping everywhere, when some areas are actually climbing. The numbers can be misleading. You'll hear headlines like Canadian real estate prices are falling, but there's really no such thing as the Canadian real estate market. Even within Calgary, we've got multiple markets moving differently. So when people read a stat like prices are down in Calgary, they might assume that means every home in every quadrant is dropping in value, but that's just not the case. Here's an example. If you are looking for a detached home in the city center or West Calgary, you might think you'll be scoring a deal right now, but prices are actually up in those areas year over year. Now, I'm not saying they've skyrocketed, but they've still increased. You can see how confusing that can be, especially for buyers who are trying to make a smart move. Let's break it down. Starting with sales for July, we saw 2,099 homes sold. That's down 11.6% year over year. Now, even looking back at July sales since 2011, we're at higher levels, which, as I've mentioned before, our city has grown, so we will set a new benchmark for sales. So when we say long-term trends, at some point, looking back at the data will not be as relevant to compared to now. The current benchmark prices are detached homes are 761,800, down 0.8% year over year, not even 1%. That is essentially flat. Semi-detached homes are at 697,500, up 1.4%. Row homes, 446,200, down 3.9%. And apartments, 329,600, down 4.8%. The citywide total residential benchmark price is 582,900, which is down 3.9%. So yes, the overall price is down, but it's being pulled down by specific segments, especially apartments and row homes. Sales to list price ratio was 98.3%. As you know, I love to track this one. In July, only 9% of homes sold over list and just over 11% sold at list price. So 21% of buyers paid full price or more, which is a good reminder that even in a shifting market, not everyone is getting a deal. And some of those overlist sales, yeah, they were intentional pricing strategies, listed below perceived value to attract multiple offers. So when you hear sold over list, that doesn't always mean the buyer went wild. Sometimes it means the seller was smart. And if you're a buyer relying on the citywide or national headlines, you're going to be surprised when you start your home search or expect a major price drop. If you're searching for a detached home or semi-detached, you'll probably have a while to wait for a significant price drop if it comes. In July, we saw 3,911 new listings and 8.5% increase year over year. Let's discuss the sales to new listing ratio because this basically tells us how competitive the market is. It's the percentage of new listings that actually sold in the same month. So if we had 100 new listings in July and 50 of them sold, that would be a 50% ratio. If the ratio is above 60%, that usually means sellers have the advantage. Homes are selling quickly and there's more competition. And if it's between 40 and 60%, that's considered a balanced market. And if it's below 40%, buyers generally have the upper hand because the listings are piling up faster than they're selling. In July, Calgary's sales to new listing ratio was 53.67%. So we're in balanced territory overall. But remember, this number is citywide. Some neighborhoods or property types are hotter than others, and the ratio there could look different. Linked below, you're going to find the market report that I'm referencing, but each neighborhood has its own stats package, so shoot me a message if you'd like any of those. Now let's talk inventory because this part is crucial. The Calgary Real Estate Board has said, thanks to gains mostly occurring in the newer communities, inventory levels in July were 6,917 units, reaching levels not seen since prior to the pandemic and higher than long-term trends. Okay, now I want to take a look back at inventory levels prior to the pandemic so we can really dive into what's happening here. Because in 2018 and 2019, we saw inventory levels higher, and 2019 similar to where we are now. And you might think, well, shit, those years were a struggle for our market. And yeah, that's true. But in 2018, we had 1,547 sales, and our months of supply was 5.48. And in 2019, we saw 1,646 sales, and our months of supply was 4.36. So very much buyer's markets. Homes were selling for less on a list price to sales price ratio, and were taking much longer to sell. So yes, while the inventory levels were similar, the market was very different. Right now, most of the new inventory hitting the market is in the detached segment, which also happens to be where we see the most sales. So yes, that category is balancing out, but it's also still moving. We're also seeing most of the supply in newer communities where we also see more competition from the new home market. Detached home construction is up 6.2% year over year, while rental development is exploding, up nearly 40%, which could push vacancy rates higher despite the insane population growth we've seen. The apartment market is where supply is coming on faster than it can sell compared to other segments. And that's where we're seeing the biggest price declines, which makes sense. Condo apartments typically see price corrections faster in a downturn, followed by row homes and so on. Detached homes tend to be more resilient over time. So far in 2025, inventory peaked in June when we saw 6,941 active listings that month, and in July, we're actually ticked down slightly to that 6,917. Now, 2024 was weird because our market started cooling later, so inventory peaked in September. But if we look back to 22 and 23, inventory peaked in June and July, and then started that slow seasonal decline into winter. So the big question is, have we already seen our inventory peak in 2025? Could be. We'll keep watching that closely. We're sitting at 3.30 months of supply, so very much in balanced conditions overall. Again, apartments are just at that threshold for buyer's market with row homes to follow. Semi-detached and the detached market are just barely out of a seller's market, just a smidge, but just under 3 months of supply. If you're selling, you can't price like it's March 2023 anymore. The market's shifted and buyers adjust quicker than sellers. Homes that sit often sell for less, but well-prepped, well-priced homes are still seeing action. Just don't play that overpricing game because that ship has sailed, my friend. If you're a buyer, you've got more choice now, especially over $700,000. But when a great home pops up under $600,000, you may still be competing because that segment still has limited supply in certain quadrants. So, will the drop we've seen so far keep going? In some segments, yes. In others, maybe not. But one thing's certain, the people who do best in this market are the ones who understand the real numbers, not just the headlines. And that's the difference between making the right move and making the ones that could cost you big. And if you're trying to wait for the bottom, I'll wait till the market drops 50%. Just remember, you only know it's the bottom once prices start going back up again. The best time to buy is when you're financially ready and you find the right home. No one should tell you when to buy, okay? You do you. What do you think? Are we already in a recession? Are prices going to take a steep drop from here? I've said it before, but I really do love the conversations we have here, so please chime in below. And while you're down there, subscribe and like all the things if you found this video helpful. You'll see the link there as well if you want to connect with me directly. Thanks for watching, and I'll see you soon.